Most people think Roth conversions are the go-to way to cut retirement taxes. And for some people, that's true. But what if I told you you can get the same benefit or even better tax savings without doing a Roth conversion at all? Now, it's not a loophole, it's a timing strategy, fully within the rules. Now, if you think the only thing that matters when claiming Social Security is your age, you could be missing out big time. And to make this real, I'm going to share with you a short case study of a couple who lowered their taxes, cut their future RMDs, and never needed to do a Roth conversion. Hi, my name is Jeremy Finger. I'm a certified financial planner, and I've helped successful people retire for almost 30 years. Most people choose when to claim Social Security based on age. They take it at age 62 because it's available, or they wait until age 70 just to get a max check. But what they're overlooking is tax timing. Claim at the wrong time and you can push your income high enough so that 85% of your benefits are taxable. And you also shrink your tax window, which it makes managing your withdrawals more difficult. And Roth conversions so expensive that they stop making sense. Here's what most people miss. They could have saved more by claiming later, not just from a bigger check, but also lower taxes too. You see, Social Security becomes taxable based on a provisional income formula. That's your other income plus half of your Social Security benefit. Now, when you add in Roth conversions, those conversions count as income in the year you do them. And if you're already collecting Social Security benefits, those conversions stack on top of your Social Security. And they can push you into higher brackets, triggering you more taxes on your benefits. So you're not just paying taxes on the conversion, but you're also paying more taxes on those Social Security benefits you're already claiming. But what if you could get the benefits from a Roth conversion without actually converting and lower your taxes on Social Security? The first move most people miss is simple: delaying their Social Security benefits and using your pre-tax IRA accounts in the early years of retirement. You see, those gap years are your tax window. You can control your tax bracket way better. You shrink your future RMDs and you lower your lifetime taxes. Now, if you have a small after-tax account, say a joint account, keep that as an emergency cushion and then fund most of your living expenses from your pre-tax IRA accounts while keeping your tax bracket lower. Now, if you have a larger after-tax joint account, blend the withdrawals. Take some from your IRA, consider doing small Roth conversions while your Social Security benefit is delayed. Now, in either one of these scenarios, you're reducing your pre-tax accounts now, which reduces your RMDs later. And you're locking in a much higher Social Security benefit when you finally do claim. This dramatically increases your benefit while reducing the strain drain on your investment portfolio. Now, if you want to see all this with your numbers, watch my free training video on the Riverbend Bridge method. It's the same framework we use with a lot of clients, and it helps them retire early and lower their lifetime taxes. The link is in the description. But let's keep going. Many people think they need to claim Social Security early to retire early, but they don't. And let me show you what I mean in the following case study. You got a couple here, John and Mary. They got two paths. Both of them are age 62, and they have $1 million saved in their pre-tax IRA accounts, $400,000 in their joint brokerage account, and $100,000 in cash at the bank. Path A, let's say that they claim their Social Security now. Great. Their Social Security checks start at age 62. And on top of that, they do some Roth conversions. But their conversions raise their ordinary income levels. And it also pushes more of their benefits into taxation. The result is higher taxes, possible Medicare surcharges, and a bigger RMD later in their 70s when they turn age 73. So Path A gets the benefit of Social Security right away at age 62. And you can see here they expect to collect about $50,000 per year throughout their 60s by going this route, and they get to minimize the amount of outflow from their investments. Sound good, right? So why in the world would they choose to delay the benefits when claiming earlier seems so good? Now let's talk about Path B, delaying Social Security benefits. And what that is you use your gap years from age 62 to 70 to pull income from your pre-tax IRA accounts while in your lower brackets. And you can use your cash account for emergency expenses that always seem to pop up. You want to keep your taxable brokerage accounts for those extra one-off needs and tax flexibility. Now, if your after-tax balances are large, that may allow you to do small surgical conversions up to the top of your tax bracket. But I'm going to show you later in the video another option which may be way better. But if they did delay their Social Security benefit and did some small conversions, by the time they were 70 years old, their pre-tax IRAs are much smaller, their RMDs are lower, and their Social Security check is much, much higher. And their lifetime taxes are a lot lower. But here's how delaying their Social Security benefit looks. You can see right here that the net outflow from their investments is much higher in their 60s. But keep in mind, you're withdrawing from a very low tax bracket in your 60s. At age 70 is when the advantages start to pile up. You can see here in your 70s, their Social Security income has basically doubled compared to what they would look like if they took it early. And because of that, the amount they need to take from their investments is dramatically reduced. Let me show you how that looks on the financial plan. This is a side-by-side comparison showing the differences between claiming early and claiming later. The one on the left is delaying, and the one on the right is taking it early. There's a $150,000 difference in lifetime expected assets if you delay, and that's on top of the odds of success going from 87% to 98%. And that peace of mind can be monumental. Now, delaying Social Security benefit is only part of the picture because the real advantages come when you know exactly how much to pull from your pre-tax accounts to stay in the low 12% bracket. So if you're married filing jointly in 2025, the 12% bracket tops out at $96,950 of taxable income. The standard deduction is $30,000. And if you're over to age 65, there's an extra $1,600 for each spouse. And from 2025 to 2028, the One Big Beautiful Bill Act adds another $6,000 per person for people over to age 65. Now that does phase out at higher incomes. Here's what that means in plain English. If both spouses are under age 65, you could have $126,950 of ordinary income before you leave the 12% bracket. That's $30,000 standard deduction plus $96,950 on top of that bracket. Now, if both spouses are over to age 65 and under the OBB phase out, you could have around $142,000 of ordinary income before you leave the 12% bracket. That's a $30,000 standard deduction, $3,200 for age-based, plus $12,000 from the One Big Beautiful Bill, on top of your $96,950 top of the 12% bracket. As always, you need to subtract any pension, wages, or interest income from these amounts. That's why if we're working with a client, we want to make sure that we understand all the different accounts that are not held by us and what the taxability of that is. What is left is the amount you can withdraw from your IRA account and still stay in the 12% bracket. Now, another thing many retirees miss, and it's very important, is the 0% capital gains rate. That's another lever you can pull to beat a taxable Roth conversion. You can harvest long-term capital gains at a 0% federal rate as long as your taxable income stays below $96,700 for married filing jointly in 2025. A key point is that threshold is taxable income, not AGI or adjusted gross income. Your ordinary income fills the space first, and whatever's left up to the $96,700 is where long-term capital gains rate and qualified dividends would be taxed at a 0%. Why this is a win is that a Roth conversion creates ordinary income. You pay 12% or more when you convert, whatever your tax bracket is. But a 0% capital gains harvest lets you raise your cash and reset your cost basis with no federal capital gains tax at all. And what this also does, it preserves your tax flexibility later. So which should you do? If you have ordinary income that already fills up the 12% bracket, a conversion may make more sense for you. But if you have room under the 0% gain ceiling, harvesting gains may be a smarter move than forcing a Roth conversion. Now, we test this with our clients to see which one's best. But what I want you to do is, if you're doing it on your own, make sure you work with a tax professional who can run through these numbers for you. Another key point to remember is we're not including state taxes in this example, but you also need to keep in mind about your modified adjusted gross income, which can affect IRMA charges 2 years later. So again, coordinate this with your tax professional. Now, a good rule of thumb, if you have a small after-tax money, let's just say $100,000 to $200,000 in a joint account, you may want to consider keeping that as an emergency cushion. Use the pre-tax withdrawals to fill in your 12% bracket in those gap years. Maybe skip Roth conversions altogether. Consider taking 0% capital gains if you fall within that bracket. But if you have large after-tax money, then you may be able to blend IRA withdrawals with targeted Roth conversions or 0% capital gain harvest, whichever one gives you the lowest lifetime bill. The bottom line is this: reducing your pre-tax accounts now reduces your RMDs later, and if you combine that with delaying your Social Security benefits, you may be able to lower your taxes and increase your guaranteed income for life from Social Security. Now, if you've already started taking Social Security and you're like, oh shoot, Jeremy, I've already taken it, you have a one-time reset option if you've only taken it for less than 12 months. You file Form SSA 521 and you can renege on the Social Security. Now, you'll have to pay the Social Security Administration whatever you did receive, but that will reset your Social Security delaying schedule, and then you can continue to delay. So to recap, you may be able to delay Social Security benefits and you reduce your lifetime taxes by living off of some of your pre-tax IRA accounts in the gap years of your retirement. If you want a plan built around your income, your accounts, and your timeline, watch the free video on the Riverbend Bridge method. It's short, it's free, and it could share with you how you may be able to save thousands of dollars of unnecessary taxes. The link is in the description. I hope all is well with you and your family, and I'll see you in the next video.